Morning, it's David Stewart from Straight Talk Wealth Management, my Monday meetings for the 8th of November 2021. I've headed this one. There are two worlds when it comes to retirement. I've just read an article about the university lecturers who are going to go on strike because they're being asked to contribute a bit more towards their pension scheme. At the moment, they have a total of 30.7% of the salaries paid into the scheme. They pay 9.6%, and their employers pay 21.1%. After calculating the future liabilities of the scheme, it's been found that there is a deficit, that is the lack of funds, to the extent of £14 billion. Just in case you missed that, a deficit of £14 billion. So what this means is the pension regulator and the trustees have calculated that to pay the benefits that they've been promised, the scheme is short of £14 billion. So clearly, the regulator, the pension regulator, has advised the trustees of the scheme that the funding level has to rise to 56.2% of salary. Without wishing to comment on whether these folks who want to go on strike are right or wrong, I'd like to make a couple of comparisons. The workplace pension, which many employees find themselves in, mandates that there must be just 8% of salary paid in. Now let's think about that. 8% as opposed to 30.7, or indeed the new figure 56.2%. The vast majority of self-employed people can only dream of making pension contributions at 30.7%, let alone 56.2%. And let's not forget that most people are employed in these small and medium-sized enterprises and can't, again, even contemplate having a 30% pension contribution. The argument then seems to be, are the self-employed and the people who work for them who are not in one of these schemes that are available only to people who work in jobs such as civil servants, university lecturers, which at the end of the day really are paid by the taxpayer one way or the other, either through student loans or taxes? Are they more entitled to a decent retirement than the rest of us who have either created jobs and wealth or created our own retirement? Or should they thank the lucky stars and not cause our young students any more pain than they've already gone through in the recent past? Changing slightly, I won't bang on about the decision by the Bank of England to leave rates where they were, as no doubt you've seen this covered in depth elsewhere. The real enemy is inflation, combined with poor interest rates paid on your investment. Recent analysis shows that the best fixed rate bond on the market, launched last September, had a rate of 1.2%. This would have turned a £10,000 investment into £10,120. With inflation running at 3.1%, this gives a buying power of £9,816. The frightening thing is this is better than National Savings Investment, which are paying 0.01%. The best easy access account over the period paid 0.67%. With the Office of Budget Responsibility forecasting inflation at an average of 4% next year, and the Bank of England forecasting a peak of 5% in April next year, these rates of return are looking more and more disastrous. Although you should, of course, have your rainy day fund in cash, it really is time to take advice, get your non-rainy day money properly invested. And then going back to where we started, if you're thinking about funding your retirement and you're not one of the lucky folks who works for university, you really should talk to somebody to discuss the level of contribution you should be making to enable you not to have to give things up when you get to retirement. So, David Stewart, Straight Talk Wealth Management. If you would like to see how the markets have performed over the last week, please go to our website. I look forward to talking to you next week. Thank you for listening.